The countdown has started, and this time the numbers are not ambiguous. American early warning satellites, the space-based infrared system, the most sophisticated missile detection architecture ever built by human civilization, just tracked 120 Iranian ballistic missiles moving into pre-launch positioning across multiple sites simultaneously. Not one site, not a regional cluster that could be explained away as routine military rotation. Multiple sites, dispersed, coordinated, fueled, aimed, 120 missiles representing the single largest Iranian pre-launch posture ever detected by American intelligence in 45 years of watching this country with every sensor the most expensive surveillance apparatus in human history can deploy. Let that number sit for a moment. 120 missiles. The April 2024 Iranian strike on Israel, the one that sent financial markets into immediate convulsion, that spiked oil prices 4% overnight, that triggered emergency G7 consultations, and a week of breathless news coverage, involved 170 projectiles total, including drones and cruise missiles, with approximately 120 ballistic missiles in that mix. And that strike was Iran's opening move, a calibrated demonstration designed to show capability while maintaining escalation control. What American satellites are detecting right now is not a demonstration. The positioning pattern, the dispersal geometry, the fueling sequence timeline, every analytical signature points to one assessment. This is operational preparation for a strike that is not meant to send a message. It is meant to cause maximum damage before the other side can respond. This is the moment every financial model, every geopolitical risk framework, every sovereign debt calculation built on the assumption of Persian Gulf stability just became simultaneously obsolete. Not gradually, not over a quarter, overnight. And the financial earthquake that follows a 120 missile Iranian strike is not a risk scenario in a bank's stress test document anymore. It is a countdown, and the clock is running. To understand what 120 missiles actually means in operational and financial terms, you need to understand the mathematics of saturation attack. This is the concept that Iran's entire strategic missile doctrine has been built around for 2 decades, and it is the concept that makes the number 120 so specifically, deliberately, financially catastrophic. Every American Patriot PAC-3 battery can engage approximately 8 to 12 targets simultaneously under optimal conditions. A carrier strike group's combined air defense envelope, Patriot batteries, SM-6 interceptors on Arleigh Burke destroyers, Theod if pre-positioned, can engage perhaps 40 to 60 incoming targets simultaneously before the defensive stack is overwhelmed by the rate of simultaneous intercept demands. The U.S. military's total interceptor inventory in the Persian Gulf theater at any given moment is finite, classified, and almost certainly insufficient to handle 120 simultaneous ballistic missile tracks arriving from multiple azimuths with varying trajectories and terminal velocities. Iran knows these numbers. Iran has spent 20 years studying every American missile defense deployment, every interceptor inventory disclosure that has leaked through congressional testimony, every after-action analysis of Israeli and Saudi intercept operations against Iranian and Iranian proxy missiles. The number 120 was not chosen randomly. It was chosen because Iranian military planners calculated it as the threshold above which American and Allied theater missile defense systems cannot guarantee intercept rates above 50%. Below 120, American defenses might stop most of the missiles. At 120 simultaneously launched from dispersed sites, the mathematics of simultaneous intercept demand guarantees that a significant number get through. And here is where the financial dimension of this military calculation becomes the real story. The targets these missiles are pre-positioned to reach are not exclusively military. The Persian Gulf's critical infrastructure, the oil processing facilities, the LNG terminals, the desalination plants that provide drinking water to populations that cannot survive without them, the port facilities that handle 30% of global containerized trade, all of it sits within range of Iranian ballistic missiles. Saudi Arabia's Abqaiq facility alone processes 7% of the world's daily oil supply. A single successful strike on Abqaiq, which Iranian drones demonstrated was entirely feasible in September 2019, removed 7 million barrels per day from global supply instantaneously. 120 missiles aimed at the full spectrum of Gulf infrastructure doesn't just spike oil prices. It restructures the entire global energy supply architecture in ways that cannot be reversed in days or weeks or months. The Strait of Hormuz carries 21 million barrels of oil per day. It carries 77 million tons of LNG annually. It carries the financial viability of every oil-dependent economy on Earth through a channel that is 21 miles wide at its narrowest point. Iranian mining operations, which the IRGC Navy has rehearsed extensively and which require no ballistic missiles whatsoever, can close that channel within hours of a decision to do so. Pair the mining of Hormuz with 120 ballistic missiles aimed at Gulf processing infrastructure, and you have not a military strike. You have a financial nuclear weapon detonated at the exact geographic point where the global economy is most structurally vulnerable. Brent crude at $180 is not an extreme scenario in this context. It is the conservative estimate. Goldman Sachs's 2019 analysis of a sustained Hormuz closure conducted before the massive increase in global LNG dependency on Qatari supply following Russia's 2022 pipeline cutoff projected oil prices exceeding $150 within 30 days of a full closure, updated for current supply dependencies, current strategic petroleum reserve levels that are at their lowest since 1983, and current global refinery capacity constraints, $180. Brent within 2 weeks of a full Iranian escalation is the number that the traders who actually move physical oil are using in their private calculations right now, not as a worst case, as a base case. This precise moment, a rising power deploying a massive coordinated strike capability against the infrastructure that sustains a dominant empire's financial architecture, has appeared before in history with a regularity that should terrify anyone paying attention. Not similar moments. This exact structural dynamic, repeated with the mechanical precision of a historical law, at every major transition point between dominant powers for the past 600 years. Study Carthage in 218 BC. Hannibal Barca crosses the Alps with 37 war elephants and an army that Rome's strategic planners had assessed as incapable of threatening the Italian peninsula directly. Rome's military doctrine, its financial architecture, its entire imperial self-conception was built on the assumption that the Alps were an impenetrable defensive barrier, the ancient world's equivalent of a missile defense system. When Hannibal's army descended into the Po Valley and began destroying the agricultural infrastructure of northern Italy, the farms, the supply depots, the road networks that sustained Roman military logistics, he wasn't just winning battles, he was attacking the financial foundation of Roman power. The agricultural surplus of northern Italy funded the legions sustained the empire. Destroy the surplus and the entire financial military system begins to unravel from its base. Rome survived Hannibal, but the financial cost of surviving him, the emergency property taxes, the debasement of the silver denarius that began during the Second Punic War, the debt obligation that the Roman treasury accumulated across 17 years of fighting a war on its own territory, planted the fiscal seeds that would constrain Roman strategic flexibility for generations. The military victory over Carthage was real. The financial damage from the method of that victory was permanent. Rome was never again the financially unencumbered power it had been before Hannibal crossed the Alps. America faces a structurally identical dynamic with Iran's 120 missiles. Even if American and Allied missile defenses perform optimally, even if the intercept rates exceed all realistic projections and the physical damage is contained, the financial cost of the response permanently alters the American fiscal position in ways that compound the existing debt crisis rather than being absorbed by it. Each Patriot PAC-3 interceptor costs $4 million. Each SM-6 costs $4.3 million. A 120 missile saturation attack requiring maximum intercept effort depletes interceptor inventories, whose replacement given current Raytheon and Lockheed Martin production rates takes 18-24 months per battery reload. The military response to a 120 missile strike costs between $2 and $4 billion in interceptor expenditure alone. The replacement timeline leaves the theater defense architecture degraded for nearly 2 years. And Iran's missile production rate, running at an estimated 200 to 300 new ballistic missiles per year, means Iran replaces its expended inventory faster than America replaces its expended interceptors. This is the hidden financial trap that 120 missiles represents, not the strike itself, the exchange rate economics of the strike and its response. Iran spends $60 to $120 million launching 120 missiles. America spends $2 to $4 billion intercepting them and 18 months rebuilding the defensive inventory. Iran launches again in 6 months with a replenished arsenal. America intercepts again at $2 to $4 billion, and another 18-month rebuild cycle. Do this exchange 4 times and Iran has spent $500 million. America has spent $16 billion, and its theater missile defense architecture has been in a degraded state for 6 of the past 24 months. Do it 8 times and the arithmetic becomes a strategic collapse dressed in military language. The British Empire ran this exact calculation in reverse in the 1930s and reached the wrong answer. The RAF Spitfire and Hurricane production rates were running below German Luftwaffe production rates throughout the rearmament period. British Treasury officials, aware of the fiscal constraints that the First World War debt burden had imposed, were actively arguing against accelerated fighter production as late as 1938 on cost grounds. The financial logic was sound in isolation. The strategic logic was catastrophic in context. By the time Britain recognized that the exchange rate economics of air defense required financial commitment that overrode normal Treasury constraints, the gap had grown to a size that required American financial intervention, lend-lease to bridge. Britain's financial sovereignty ended at precisely the moment its strategic vulnerability became undeniable. It never fully returned. America's $34 trillion debt, its $1 trillion annual interest burden, its structural deficit of approximately $2 trillion per year, these are not background conditions to the 120 missile crisis. They are the crisis beneath the crisis. They are the reason the exchange rate economics of missile defense and missile offense are so strategically dangerous right now. A financially unencumbered America could absorb the interceptor cost, accelerate production rates, and outspend Iran into submission the way it outspent the Soviet Union into dissolution. A financially overextended America running a $2 trillion annual deficit cannot absorb those costs without making explicit choices about what other obligations it cannot simultaneously meet. And those choices: defense versus entitlements, interceptors versus infrastructure, military readiness versus debt service, are the choices that determine whether empires survive their decisive moments or discover too late that the decisive moment arrived after the fiscal capacity to meet it had already been consumed. Watch 4 specific financial signals in the next 48 hours that will tell you exactly how serious the people with the best information believe this is. First, watch the 5-year Treasury inflation-protected security spread, the TIPS break-even rate. This is the bond market's real-time estimate of future inflation. If institutional money believes a 120 missile Iranian strike is imminent, and that it will generate an oil price spike that embeds inflation for 18 to 24 months, the TIPS break-even rate moves before any public statement. It moved before the 2022 Ukraine invasion. It moved before the 2019 Abqaiq attack. It will move before this. Second, watch Saudi Aramco's stock price in Riyadh trading. Aramco shareholders with access to the same intelligence feeds that CENTCOM is reading will reduce exposure to a company whose primary processing infrastructure is within range of 120 pre-positioned Iranian missiles before any public warning is issued. Unusual Aramco selling pressure in thin morning trading, without any company-specific news catalyst, is the most direct financial signal that informed money is repositioning ahead of an event that has not yet been publicly disclosed. Third, watch the Israeli shekel against the dollar. Israel's currency is the most sensitive real-time geopolitical risk barometer in the Middle East, because Israeli institutional investors have both the intelligence community relationships and the direct existential stake that makes their currency positioning the most honest available signal of genuine crisis probability. Shekel weakness that cannot be explained by domestic Israeli economic data is Iranian escalation risk being priced in real time by the people closest to it. Fourth, watch physical gold premiums over paper gold, the spread between allocated gold in Zurich vaults and COMEX futures prices. When this spread widens suddenly, it means institutional buyers are paying above market prices for immediate physical delivery rather than paper claims. They do this when they believe the paper financial system itself is about to face a stress event, serious enough that paper claims on gold become less reliable than physical possession. This spread widened sharply in the 72 hours before the 2008 Lehman collapse. It widened before the 2020 COVID market crash. It is the financial system's most honest fear indicator. Watch it now. Here is what 120 missiles aimed at the Persian Gulf actually means at the deepest level of historical analysis. Every empire in history has had a moment when its military capability and its financial capacity diverged, when what it needed to spend to defend its position exceeded what its fiscal architecture could generate without self-destructive borrowing. The Roman Empire hit that divergence in the 3rd century. The Spanish Empire hit it in the late 16th century. The British Empire hit it in 1940. Each empire responded to that divergence with the same combination of financial innovation, strategic contraction, and institutional denial, trying to maintain the appearance of full-spectrum dominance while quietly, irreversibly reducing the substance of it. America is at that divergence point right now. The 120 missiles are not the cause of it. They are the stress test of it. They are the historical mechanism by which the gap between perceived power and actual financial capacity gets measured in real time, in the most public and consequential theater available, with consequences that cannot be reversed once the measurement is taken. The countdown has started. The financial system has not yet priced what is at the end of that countdown. And the gap between those two facts is the most important gap in the world right now. Because when the gap closes, when the financial system finally prices what the satellites already know, the adjustment will not be gradual. It will not be orderly. It will not give ordinary people time to position themselves ahead of it. It never does, not once, not in any empire, not in any century. The pattern always repeats, and the countdown is already running.